Every country says that its money is safe. Every government claims that its promises will last forever. And every time history proves the opposite. From Rome to France, from the Confederacy to modern Lebanon, people have woken up and realized that their savings were worthless, their salaries meaningless, and their future stolen by systems they believed were safe. Collapses are rarely the exception. Collapses are the rule. The real question is not whether financial systems fail, but how you protect yourself when it happens. The illusion of permanence is the most dangerous financial error of all. We look at our account balance, our national currency, and assume that they are a rock foundation. But money is not a foundation, money is trust. And trust can disappear overnight. That is exactly why history is so brutal and so useful. Every collapse leaves behind a trail of lessons, patterns, and warnings about what protects wealth and what turns to dust. And whoever looks closely recognizes the survivors of these catastrophes were never the ones who trusted the most. They were the ones who doubted first. Take the Byzantine Empire. It is often remembered as the eastern part of Rome that somehow survived 1,000 years longer than the Western Roman Empire. At the center of its economy stood the gold solidus, a coin so reliable that merchants in Europe, the Middle East, and Asia accepted it without hesitation. For centuries, it was what came closest to a global reserve currency. But here comes the part loyal viewers will appreciate. One might think the Byzantines had learned from Rome's mistake with the silver denarius, which emperors debased so heavily that it was eventually nothing but tin with a touch of silver. We have told this story many times, but no, centuries later the Byzantines made the same mistake again, this time with gold. They began to reduce the purity of the solidus and stretch it with cheap alloys. At first no one noticed, then trust broke. The coin that had once stabilized Mediterranean trade became a political fairy tale. The debasement destroyed its credibility, and with it the economic stability of the empire. What survived? Not paper, not government decrees. Merchants who quietly hoarded real gold or land outside the imperial borders were able to preserve their wealth, while everyone else saw their money evaporate. That is the first lesson. Governments cannot resist the temptation to dilute their money, and when they do, real value flees into things they cannot counterfeit. But not every collapse comes from rulers playing with coins. Sometimes it comes out of nowhere. In the 14th century, Europe was hit by the most devastating pandemic in its history, the Black Death. Between 1347 and 1351, up to half of the European population died, cities emptied, villages disappeared, trade routes collapsed, and yet the economic story of the plague is more complex than a pure catastrophe, because when half the workforce dies, labour becomes valuable. Survivors can demand higher wages. Food and land, once scarce, became abundant relative to the number of people. Families with liquidity, silver, goods, or simply the ability to work, suddenly had power they had never imagined. Land that once cost a fortune was available for a fraction. Houses stood empty, fields remained untilled. The survivors lived in a buyer's market. Does that sound familiar? During the COVID pandemic, we saw a modern version of the same pattern. Disrupted supply chains, governments printing trillions to keep the system running, and growing inequality between those with liquidity and those living paycheck to paycheck. In the USA, real estate prices and stock markets rose rapidly, while millions struggled to pay rent. The parallel is clear. Pandemics redistribute wealth. They always have. After the Black Death, peasants climbed the social ladder because labour was scarce and land was cheap. After COVID-19, those with liquidity bought real estate, stocks and businesses that others could no longer hold. The lesson is uncomfortable but true. Crises reward those with reserves and punish those without. And while pandemics show how quickly shocks can flip an economy, the collapse of the banking system in Renaissance Florence shows something equally important. Institutions that appear too big to fail can fall like dominoes. In the 1340s, Florence was Europe's financial centre. Powerful banking houses like the Bardi and Peruzzi lived there. They had lent massively to kings, especially to Edward III of England, who did not repay his gigantic debts during his wars against France. When Edward stopped paying, the banks collapsed. Depositors lost everything. Trade came to a standstill. Florence plunged into chaos. The ordinary citizen who had trusted the mighty banks realized size is not safety and reputation is not protection. The lesson: too big to fail is a lie as old as financial history. Institutions exist to profit, not to save you, and when they fall, they take your savings with them. This truth repeats itself in every century, from the Florentine crash to Lehman Brothers in 2008 to the banks in Lebanon that froze accounts in 2019. The American Civil War is often remembered as a political and military conflict, but in the background, a harsh financial war raged. Both sides had to print money. The North issued greenbacks, paper money not backed by gold but by the promise of the United States. At first it seemed patriotic, but the more greenbacks entered circulation, the less they were worth. Inflation destroyed trust. In the South it was even worse. The Confederacy printed greybacks in absurd quantities. Toward the end of the war, inflation reached astronomical heights. Wages were worthless. Families dragged sacks of money that could barely buy a loaf of bread. By 1865, the Confederates' currency was dead. What counts? Not paper, but land, food, gold, real goods, everything the government could not create arbitrarily. France provides another brutal example. In the 1790s, during the Revolution, leaders issued assignats, paper money supposedly backed by confiscated church lands. But the government printed more and more of it. The currency collapsed. Prices exploded. Farmers refused to accept paper. Bread riots broke out again. The winners were not the patriots with assignats in their pockets, but those who held food, gold, or property. 200 years later, the pattern repeats in Asia. The Asian crisis of 1997 began as an attack on the Thai baht, but spread across Indonesia, Malaysia, South Korea. Countries indebted in dollars could no longer service their loans. Currencies collapsed. Millions lost savings, jobs, homes. And the lesson? Debt in foreign currency is a death sentence. The pattern repeats everywhere, from Byzantium to Argentina. And the most recent warning comes from Lebanon. Between 2019 and 2021, the banks did something that was unimaginable to many. They simply closed the doors, accounts frozen, withdrawals limited, the currency lost over 90% of its value. Savings disappeared overnight. People begged for access to their own money, in vain. Who survived? Those who had diversified, held real assets, or kept cash outside the system. The lesson: money in the bank is not a treasure. It is a loan you give to an institution, and it can decide at any time not to repay you. It is the same story in every era. When systems break, those who survive are the ones who are prepared, not the ones who trust. So the question is not whether everything collapses. It always does. The question is, will you be one of the many holding empty promises, or one of the few holding something real? If this gave you a new perspective, subscribe to the channel. History provides the patterns. I will show you how to read them.